Drilling versus returns. U.S. oil producers trade-off as windfall tax threatens U.S. oil producers cashing in on sky-high prices or meting out billions to shareholders and building coins reserves, a approach irking lawmakers and citizens suffering with report gas charges even as triumphing over Wall Street. Soaring gas expenses have boosted inflation to a 40-year record and are anticipated to power up U.S. fuel via extra than $1 to $6 a gallon via August. That prospect has some officers arguing the industry's awareness on returns as reaping rewards a few on the cost of consumers. The trade-off among rising payouts for just the unmarried sector and more spending on manufacturing has deprived the market of nearly half of 1 million barrels of latest oil every day, primarily based on estimates of capacity output if one half of current investor payouts flowed to new oil and gasoline drilling. Earnings from most important U.S. shale, which bills for two-thirds of U.S. oil output, could hit $90 billion this 12 months, up from $37 billion in 2021, in keeping with consultancy BTU Analytics, a FactSet company. Its estimate covers most effective 32 publicly traded oil and gasoline producers. Executives are going through calls in Washington for Providence levies that could cut into strength earnings. A group of more than 30 lawmakers currently urged a congressional vote on a brand new oil tax. U.S. President Joe Biden on Friday slammed oil agencies, pronouncing they are intentionally retaining off drilling extra to pump up oil and proportion fees. NL1N2XX1VP, they're buying returned their personal stock, which must be taxed, quite frankly, Biden said. Executives and traders have argued that gasoline fees are set via the marketplace and shops, no longer manufacturers. Materials and exertions shortages have limited how rapid they are able to ramp up output, and to spend loads more on new drilling would erode capital performance and lead traders to exit. Though analysts and oil executives do not expect a Providence tax to bypass right here, Britain currently imposed a 25% oil profit tax to offset consumer energy bills, giving hope to some U.S. lawmakers featuring the tax. And resistance to the tax may also cut back as gas costs bounce and corporate profits observe. If the Conservative government within the UK can help a windfall tax, we should be capable of bypass, a US equal, said Representative R. O'Connor, Democrat of California, and a co-sponsor of the tax thought. The purpose is to raise $45 billion a year with proceeds funding bills to customers. But a windfall tax could kill the inducement to drill extra, stated oil executives, and take away some of the income that fund new generation advances that caused the U.S. shale revolution, which became the USA into the arena's pinnacle producer. It might additionally reduce oil companies' ability to elevate outside financing. This is a terrible concept, stated Mike Estman, leader government of shale producer Tall City Exploration. If you need less of something, or a few conduct, or some enterprise, tax it greater heavily. Pumping up output, not prices. Motivating windfall tax advocates is the idea that U.S. strength groups are holding off production to keep excessive fees and income. Companies returned some $9.51 billion to investors within the first quarter, according to power consultancy Wood Mackenzie. If oil manufacturers had spent half of the $9.51 billion on new drilling, it might fund a few 660 new shale wells, according to analysis using energy tech company Enverus's common prices of $7.14 million according to Shale Nicely Ultimate Year. Output varies in step with basin. However, on Common, a brand new properly can deliver a few 672 barrels of oil per day of oil, in line with BTU Analytics. Based on the additional wells and the common new shale oil output, manufacturing will be boosted some 450,000 barrels of oil per day. Those extra barrels could elevate U.S. production this year past the pre-pandemic report of 12.23 million barrels of oil per day in 2019. The authorities tasks output to upward push 720,000 barrels of oil per day to 11.92 million BPD in 2022. Making energy stocks attractive again. Between 2006 and 2019, the top 50 U.S. oil producers spent $170 billion more in capital expenditures (CapEx) than they gathered from operations. The use of debt and fairness to cowl the deficit, estimates impartial oil analyst Paul Sankey. Effectively, there had been no returns for shareholders, he said. Investors remaining decade shunned electricity companies for their loss of returns and knocked their weighting in the S&P 500, a measure of shareholder interest, to much less than 3% in 2020, from more than 16% in 2008.